Hello and welcome to this retrospective episode of Nothing Ventured, where we're going to be taking a little look at all of the guests we've had on the last season from across the pond. In this episode, you're going to hear from Adam Besvinick, founder at Looking Glass Capital, Brett Martin, VC at Charge Ventures, Michael Palank, general partner at Mac Venture Capital, Daniel Glazer, managing partner of the London office of WSGR, and Zecca Lehn, GP at Responsibly Ventures. We learned a lot from our friends from across the Atlantic, and I hope you do too. It's interesting that you said it wasn't a cool thing to do back then. And I was reading, in fact, you're talking about Twitter earlier. I was reading something that you said just yesterday, I think, right? And you said the best part of the current venture funding market is that it has provided a tremendous amount of clarity. So I think for our UK listeners, it'd be really cool to understand what is the current state of play in the venture kind of ecosystem, certainly in the US, and how you might see that kind of globally, if at all. And, what is that clarity that has been brought, and what are the implications of that?
Sure. So I think just quickly on where I think the current market sits, I think the pre-seed and seed market is still as robust and as crowded as ever. I think you've also started to see some later stage firms downshift to write more seed checks because they can get close to the same amount of ownership as a Series A investment with putting a lot less capital at risk. And so you've started to see some inflated seed rounds. I saw one person, another solo GP yesterday, tweet that she hadn't seen a seed round under $7 million in the last several weeks, which that seems like a lot of money for a seed, but perhaps these rounds are just getting inflated because you have an influx of later stage capital coming in to jam things in. But that market has not, in my opinion, hasn't really gotten much more quiet compared to some of the other later stages over the last 6, 8, 10 months. What I have found at that stage, though, is, at least for me, I'm seeing a much higher signal to noise ratio. And by that, I mean the quality of companies related to the quantity is much better. I just think the bar for starting a company right now is exceptionally high. And if you were a fly-by-night founder, or you were going to, see if you could raise a little bit of money and then quit your job based on VCs funding your idea or your side hustle, that just doesn't really happen right now the way it did in 2021. And so I'm seeing a lot more ideas and products pressure tested by founders before they actually go out to raise capital, which is refreshing to me, and ultimately beneficial for investors to have something that feels even just a touch de-risked compared to something that's, literally just an idea. Though certainly I still will fund those too for the right team and the right market. I think Series A rounds are getting done, but you need to be an exceptionally strong company and exceptionally strong team to get those rounds done at valuations that you and your existing investors are happy with. And then Series B and Series C rounds, I think, are probably the most tricky right now.
Yeah.
Sort of that growth stage deal where you probably raised an overinflated Series A or Series B in 21, or maybe early 22. Now you're in market and no one is willing to pay the price that you raised the last round at, let alone an up round, because the last two rounds were probably overvalued significantly. And then the later stage stuff, those companies might be taking down rounds, but there's still going to be a quote unquote flight to quality to winners or perceived winners, very similar to what we saw at the beginning of COVID, where pre-seed and seed still remained relatively active because people were comfortable deploying small checks over Zoom, and it felt a lot less risky. And then Series A through C was basically like a no man's land.
It was carnage.
And then Series D and later just got flooded with capital. Right. Because people were like, well, it's less about a person bet at this stage. I probably have been tracking this company for a while already. I probably already have a relationship with the entrepreneur, and let me just look at the latest numbers, and I'm just running stuff in Excel and getting comfort with that. And so I don't necessarily need to see this person face to face. I think that dynamic has emerged for different reasons now. But but I think that's a similar sort of barbell dynamic that we're seeing in the market, similar to sort of March, April, May of 2020.
And I think that's really interesting. And you're the first person I've heard talk about it in terms of what we saw in 2020. But actually, that's exactly what we saw in 2020, as you correctly point out. Like it was, I think there were ideas that weren't getting funded. There were decent pre-seed businesses which had legs, which were lower risk and therefore could get funded. But it was that mid-range of seed, Series A, where product market fit was maybe there, maybe just about there, but hard to take that hard bet and deploy a large amount of capital. Obviously, post that, you've got much more many more metrics or traction to hang your hat on. So I think that made life a lot easier. So yeah, that's a very, very interesting sort of juxtaposition. I'd also be interested to understand from your perspective, do you think we've reverted to where we were back in 2011, 2012, 13 when you were with Lowercase, as compared to the last 10 years? Like, is that the right sort of analysis, or is this a new era altogether and we just got to treat it as a completely different a different time?
I think from a valuation perspective, I think we're retreating closer to 2014 through 2016, which is when I was at Deep Fork. Fred Wilson put out a post shortly after the start of the year where he said surviving in 2023 is thriving. And he called out new sort of valuation ranges for pre-seed, seed, A and B, I think.
Yeah.
And I think Fred called out like 2015 as sort of the analog to when these types of deals would get done. I still see things that are out of, slightly above that in terms of price at the pre-seed and seed stage, but I largely think we've reverted back to sometime around there where, raising $1 million pre-seed round is getting done at, 4 to 6 post, right? You're giving up somewhere between 16 and 25% of the company for $1 million. A $3 million seed round is probably at somewhere between, 10 to 15 post. 4 million. Fortunately, I've had a lot of companies from Fund One. I've had 7 companies from Fund One raise priced equity rounds in the last 4 months. One was a company called Hone, which I mentioned in the primer, which is doing very, very well and is well beyond that from a seed range. But the other 6 were all raising between $3 and $5 million, and they're all largely giving up somewhere between 18 and 25% dilution.
Wow. Yeah.
So they're all raising somewhere between 15 to 20 million post money valuations for $3 to $5 million rounds. And some of these businesses are only a couple months old, but there's tons of momentum around them. Some of these businesses are 15 months old and they've just hit an inflection point. But largely, I think that's a valuation range and a dilution range that we saw, certainly pre-COVID and probably closer to the 2016, 2017 range from a timing perspective.
What advice do you give or can you give to founders to find the right investor at pre-seed? And I don't mean about who has the cash, who has the check, but I mean, what should they be looking for from their investor, from their VC at that pre-seed level? What are the most important things that you guys bring to the table?
Okay, I think there's 2 things here. One is something that is still poorly understood by founders, I think, which is that they think that they need to convince investors of the value of what they're doing, when instead you actually just need to find the investors who already believe in what you're doing and make that connection, right? So if you don't have a connection, if the investor is skeptical, doesn't really get it, right, or is not that interested in it, right? We've all experienced that, pitching someone and having them just it's obvious that they don't want to be there. It's obvious that they're just this is a meeting on their schedule. They're, filling time, right? The goal is not to convince that person, but rather identify that they are not interested quickly and then move them to path and drive that to conclusion as quickly as possible. A lot of entrepreneurs waste a lot of time pitching because VCs, they don't want to say no, right? It's to their advantage to just keep the optionality in case something does change or there's some other signal that says that they should invest, right? So you should be driving conclusions to no as quickly as possible, and then filling the top of the funnel and finding the person who's feels that problem acutely. They've been looking for you, or they have some personal resonance with your story, and then it's going to click. It's going to move very fast once you do that, right? And so that's what you should be looking for as a pre-seed, founder looking for pre-seed. And then the second thing is, why pre-seed? Why take a pre-seed investor as opposed to, a big seed investor or a multi-stage fund? And it's, because you want someone who's aligned with you, right? Like, and this is maybe another reason, I'm pitching my book here, but like why you would want to work with like an insurgent fund rather than an established fund is because, if you're at Church Ventures, you need all your investments to work, right? I need to raise my next fund, and I can't have companies, that have quick zeros. I need it to work out. So I'm not going to give up on you. Unlike a big multi-stage fund where, they already have a big established, they have an established reputation, and, their whole goal is if something's not going to work out, they want to cut bait on it as quickly as possible to move on to the next thing. Whereas I don't have that luxury. So I think finding funds that are aligned with you and truly are on the same page need to make it work. Like that's to your advantage.
Well, firstly, you are more than welcome to pitch your own book. That's not a problem on this podcast at all. One of the things I love there, and it's something that it's been really interesting to have learned over the last couple of years, is, getting to know as quickly as possible, right? Getting to that know. And in fact, like last year when I was looking to raise for one of my businesses, I spent 6 months sort of, traipsing around looking for that capital. And it became really, really apparent like who was interested, who wasn't interested, exactly as you said. But the most important thing for me was, can I get to that no within a day or 2 days? Because then I can just cut my losses, move on to the next one. The worst thing is when you have people stringing you along for 3 weeks, 1 month, saying, yeah, we're looking at it, we'll decide, we'll come back to you. And then ultimately it gets to a no anyway. And in fact, actually one of the founders that I worked with, I took her to a VC fund. She met, the entire team, met 2 partners, and then, was told ultimately, actually, we're not bullish on this space, or we don't have conviction that there is something to be done here. And it was like, well, you knew you weren't going to invest early on. Why didn't you just say that, straight from the bat? And I think, I think that's something that I think founders assume that once they get into the meetings of the VCs, that's always going to progress to a yes. But the reality is it may be exactly as you say, that they are just looking to understand the space better or get more data or more information about what's going on. And ultimately, they may actually end up stringing out the founder because they have the ability to do that. The founder, unfortunately, does not. They need the money in the bank, in the next month, 2 months. So I think getting to know is a really important thing, a really important lesson that I think founders need to learn, really quickly. Let's talk about data and digital literacy, because that's kind of what you teach. I understand at Columbia Business School. Why is it critical to be teaching that at MBA today? And is that different from what it was maybe 5 or 10 years ago?
Yeah. So I think there's 2 things. One is, why is digital literacy important? It's because tech, tech is eating the world, software is eating the world, right? So like every industry is now tech is mainstream. If you're trying to build something new and growth oriented, then you need to understand tech. That's pretty obvious, right? The second is around data, and I'll explain it because I was interviewing TAs one year, and I looked up and I was speaking to this smart young woman, and she had she was an MBA and had a finance background, but she was taking coding classes at Columbia, Intro to Python, and I was asking her, I said, why are you doing this? Given that she wanted to enter VC, and she said, she said to me, I think that Python is to my generation as Excel was to yours. And I had to step back because I was like, first off, I was like, man, I'm getting old. But secondly, I was thinking, I thought that was pretty smart. I was like, the future of data, the way we used to manipulate data when I was right out of college was in Excel. And I think that this next generation is going to use code to be able to manipulate data in a much more powerful way than we could. And so I think that's why data analytics is important, right? Historically, being a leader was all about, having a good gut, having a good intuition. And nowadays it's, everyone wants and as an investor, right, we want data-driven CEOs. And so, being able to be fluent with data is important. And I will say, that said, even though I teach data analytics and machine learning, I think that people are, the pendulum always swings. And so now I think a lot of people think that being a data-driven leader means, I think they sometimes confuse it with painting by numbers.
Yeah.
So they think, oh, well, I don't have to have any opinions. I just have to look at the data and it'll tell me what to do. And I want to be clear that that is not actually that useful. Oftentimes you don't have data, and oftentimes logic and intuition is actually the fastest way of making a decision. And so a lot of times you use data when you can, but you don't always have data. So I still think there's value in both, but why not have the data tool in your tool set?
What can you take away from the way Hollywood works into venture, or indeed not take away?
Well, I think, whether you're building a company or, creating a movie or a TV show, it does take a village. You watch the end of a movie and you see credits that go on for 10 minutes and the hundreds, if not thousands of people that were required to bring this movie to your screen. In the same way, if you were to, if companies had a credit sequence post IPO, it'd probably be even longer, right? Yeah. All the people that were involved from the very first day to the IPO to get this company to where it was, it does take a village. So at a very general level, there's that similarity. As we talked about earlier, in Hollywood, the center of the universe are artists. They are the ones whose creations fuel the whole industry. Without them, talent agents don't have a job, studio executives don't have a job. Truly, artists are the center of the Hollywood universe. And I think in the exact same way, entrepreneurs in our world are the center of the universe. And everyone is in service of the entrepreneur. Just as in Hollywood, everyone's in service of the artist. And I think you can get into trouble if you think you're more important than the artist in Hollywood or more important than the entrepreneur in tech. And I saw that sort of very early and clearly when I became a VC. I'm like, oh, I know this job. I did this job as a talent agent. And at seed stage VC, most of our calculus in deciding if we should invest in a company centers around our determination of the quality of the founding team and the entrepreneurs. And often at seed, certainly pre-seed, there are limited data points to go off of, and it's way more subjective than objective, way more art than science, making this determination. Do we think this person or this team, is great and can build a world-changing company? In the same way where I would go to the Sundance Film Festival back in 2005, and, you go see this kind of art film and this person has like a 5-minute role and you're trying to determine, can this person become a global movie star from this little seedling of a performance that I saw? Like, very limited data points. And then you go meet with them, you have coffee with the artist, you see the kind of person they are and their career ambitions and just how they see the world. And you're trying to determine, from just limited data, can I turn this person or help turn this person into someone huge?
That famous star quality kind of aspect, right?
The star quality aspect, and so that's very similar in these two worlds. And then at least in terms of VC and talent agents, like the competitive nature. So, okay, I determined that this person does have, at least in my opinion, what it takes. Well, I'm probably not the only one. There's probably someone at 3 other agencies that feel the same way. And now we're all competing to sign this artist. And I'm selling myself now. The tables have turned. And like, here's why you should sign with me. Here's how I would help build your career. Here's why I'm the right person for you. Well, guess what? That happens all the time in the VC world where we're selling ourselves. I mean, capital is essentially a commodity, and founders, if they're great, often have options when choosing their VCs, and it's why should I choose you? And so that was very similar to me. And so yeah, I wouldn't say it's a tried and true path from being Hollywood agent to venture capitalist, but certainly there are stories there of people that have walked that path. And Mike Ovitz famously helped Mark Andreessen and Ben Horowitz sort of think through the structure and strategy of Andreessen Horowitz in the early days. And what they pursued was a very different model than was typical at the time in VC, just as when Mike Ovitz started CIA in the late 70s. It was a very different model than what was traditional in the Hollywood agency space at the time. And so, it's not a typical path. And I think some entrepreneurs, when they look at my LinkedIn, may say, oh, wait, why am I talking to you? You used to, work with Forrest Whitaker and Will Smith and these people. And I'm like, well, actually, I just wanted to give them an abbreviated version of this story. And like, oh yeah, there are similarities. I'm very proud of this path I followed.
I mean, and it's not just similarities. I mean, I guess, both LPs as well as angels now. So if I think about, you talked about Serena Ventures being involved in one of, invested in one of the portfolio companies. Obviously, Serena's an athlete. Like, one of my good friends over here is building a platform so that more athletes can invest in venture style deals. But I would imagine that, to your point, movie stars, and you talked about Will Smith, they have capital behind them. A lot of them want to do good. They want to, make a difference in the world. They are often very outspoken people, right? With a lot of purpose behind them, often from quite humble backgrounds as well. And I would imagine that, again, in terms of the ecosystem in LA and just tying those two things together, that leads to potentially an abundance of potential partners, of advocates, of LPs, of funders, of investors, angels, etc., that come out of that ecosystem that want to do something good with their capital, having built it up over many years and doing many movies, and presumably that's really positive as well, because the other thing, I guess, about Hollywood, at least, from the outside looking in, is that otherwise it's quite a closed shop, whereas tech tends to express itself as being a very open and democratized kind of ecosystem, albeit that some people would argue venture is less democratized maybe than the tech ventures that they're funding. But from your perspective, what are the trigger points for a UK firm looking to expand into the US, and when should they consider getting the right structure in place? Yeah. And whether that should be, a topco flip to the US, which, we've talked about previously between ourselves as well, a subsidiary or something else altogether. I mean, what are the triggers, and then what is most appropriate at what time?
Sure. So the bright red line of when you need to set up a proper structure in the US typically is when you're hiring your first US employees. Mm-hmm. There's a lot of things that you can do with respect to the U.S. as a UK company that you don't need any particular structure for. For example, selling in remotely to U.S. companies, unless you're selling into certain U.S. government entities or the military, you generally can sell into the U.S. Straight through your UK company directly. Hiring contractors in the U.S. You don't need an entity to hire contractors in the U.S. Hiring employees through an employer of record service. You don't need to create a structure to do that, right? Going to meetings, generally raising money, attending conferences, negotiating contracts, all that stuff you can go to the U.S. You don't necessarily need a visa for, and you don't need a company. But the bright red line of when you would want to create the company is when you're hiring your own employees. In other words, not through an employer of record, not through a contractor arrangement, but your own proper employees, because basically for three reasons: tax, liability, employment law. In other words, you don't want to create a taxable presence of your UK company in the US. Mm-hmm. You don't want to end up with a direct line of liability to the deep pockets of the UK company from the US, and you don't want the ambiguity of UK employment rules and US employment rules with a UK employer and a US employee, in short, right? But it's going to be a subsidiary, right? Yeah. As I often say, our advice on this is a tweetable piece of advice, which is that the decision to create a U.S. subsidiary is operational and commercial driven. The decision to create a U.S. parent company is solely investor driven. Yeah. Right. In other words, to the extent that you need a U.S. company, pretty much everything that you want to do in the U.S. you can do through a U.S. sub. Right. Typically, by the way, wholly owned Delaware corporation, owned by the UK company, with the exception of, and this is the Delaware flip point that you alluded to, if you are raising typically from early stage US investors, most often seed, sometimes A, almost never B anymore. Mm-hmm. If you're raising from certain early stage US investors, some of those US investors will not pull the trigger and invest in the company unless it agrees to become a Delaware parent company.
Yeah.
Right, and that's the so-called Delaware flip. In other words, a share-for-share exchange between the UK Limited and a new Delaware corporation that results in a Delaware parent company with a wholly owned UK subsidiary. By the way, why Delaware? The headline: Delaware reduces friction. You have to incorporate you incorporate a company in one of the 50 states in the U.S. There's no such thing as a national company,
yeah.
right? We all use it with shorthand, U.S. company, and that's fine. But technically, it's a company that's incorporated in one of the 50 states. And again, Delaware reduces friction. Long ago, it established itself as the go-to state for incorporation in the U.S.
I mean, the thing that strikes me, because you said it's typically kind of that early stage. If you're seeking early stage investment, that's where a top co flip might be required. But essentially, there is no real reason for that other than simplicity for the investor. Because to your point, if they don't require it at A or certainly at B, then it can't be that there is something that is stopping an investor from investing in a UK company. It's just friction, right? Or it's just, simplicity on their side, ease of reference there. They're able to kind of navigate that sort of situation much easier than if it's a US company. So it doesn't seem like there is an actual any purpose to doing a US topco flip other than to satisfy investors, right?
So let's break that down a little bit, right? So first of all, I would say what we're seeing, especially post-COVID, is if you're looking to raise a U.S.-led seed round, and when I say U.S.-led, I mean investors who are based in the States who do not have a London office.
Yep.
Okay. So what we're seeing is usually about 75 to 80% chance that VC at seed would require a flip in order to pull the trigger. By the time you get to Series A, it's down to about 20 to 25%. I mean, and that's what's dropped materially, I think, over the course of the pandemic, and actually as more and more investors not only got used to investing remotely but got comfortable with UK companies, is that at Series A, I would say pre-pandemic, I would have put that number at about 60 to 70% chance.
Okay, as high as that.
And it's down to about 20 to 25% now. Yeah. And we haven't seen a Series B or later UK limited company have to flip to take in money in a long time, right? So I mean, I'd put that at virtually zero. But at the early stage, to go to your point, look, to some extent, it's simply friction. It's simply that the companies are, from the U.S. investor standpoint, frankly, too fungible at that stage to go out and find UK counsel and understand, well, what are my rights as an investor in a UK company, because again, Delaware reduces friction in the respect that US VCs know exactly what their rights and obligations are under Delaware law. And anytime they invest outside of Delaware, they have to go and try to figure it out. And the earlier you are and the more fungible you are, the less interested the US VC is going to be to do that. That is one consideration. However, there are a few other considerations. For example, there are certainly some US funds in their fund documents prohibit the fund from investing into companies based outside of the United States. Sure. And we always tell UK, European companies we work with, that's not negotiable, right? I mean, if the VC has that restriction contractually in their documents, then you as the company need to decide.
Because they'll only have been able to raise from the LPs based on having that restriction.
Right. Now, in fairness, that is not that common in the United States, but there are still certain funds that have that. Also, in fairness, there is some benefit, and I don't want to oversell this. I want to preface this, right? I don't want to oversell this. However, there is some moderate benefit when you are hiring U.S. employees to provide the options to those employees out of a Delaware parent company as opposed to a UK limited. In other words, it's a little bit more tax beneficial to the employee. On the other hand, I mean, I can't tell you the number of UK limited companies that we work with who very easily go out and hire in the US and provide options to US employees. To the extent that this becomes an issue, you just simply gross them up a little bit and provide them a little bit more in options. But I'll tell you the bottom line takeaway that we always tell companies on the Delaware flip, which is the following. At the end of the day, don't worry about it. Okay? Here's what I mean by that, right? Wait until you go out and start talking to U.S. investors. And if U.S. investors who you are interested in, start saying to you, you seem like a pretty interesting company, but I'm a little bit hesitant to invest in a UK limited company, then you say back to them, you say, great. If that's the last gating item for you, then we can talk about that about flipping into Delaware, and we could build it into the term sheet.
Yeah.
Right, because that protects both sides. If you
Yeah,
build
so
it into the term sheet,
you only do the flip if the investment comes through, rather than
if you know that the money is
Yeah.
going to come to
Yeah.
fund the flip, and that protects both sides, protects the VC, and that they never have to deal with the limited, because the flip completes first, then the financing docs come in, and the money comes into the Inc., the corporation.
Mm-hmm.
But it also protects the company, is that they don't commit to spending the money, and because it can be expensive, especially if you have SEIS or EIS, and you need to save that SEIS, EIS treatment for earlier stage investors, which, by the way, you can do. You can save it, but it's a complicated transaction. You don't commit to that unless you know that there's going to be an investment there waiting for you.
You mentioned this other issue, and I'm really glad you did, because one of the questions is, how do you actually measure impact, right? Because you recently published yourself an article citing 50 impact metrics that early stage founders could track, but changes in many of those metrics, right, like poverty, literacy, crime rates, civic engagement, etc., can only be seen over the longer time frame. So how do you know if the startups you're investing in...
Perhaps, I mean, I do see, generally, I think you're correct in that, but that's perhaps, I mean, there...
Sure.
So one more time, the question.
Yeah. So I guess the question is, like, how do you, I mean, you started answering the question. How do you know if the startups you're investing in are actually achieving that real change or change at a pace that's enough, right?
This goes into the realm of claims. So this is more of a legal question, actually.
Interesting.
I don't make any claims around impact. And that goes against the logic. It seems as though I should be, right? It seems as though I should be claiming that our portfolio has reduced X number of CO2 tons, et cetera, et cetera.
Yeah.
Well, I want to remind you that we're a pre-seed fund. And like you said yourself, we're backing innovation. We're backing the potential. 9 times out of 10, what would it matter what they measure? They can pivot 10 times, and they will. In fact, I actually have to say, frankly, that most of the time we're backing teams that are driven by some greater purpose. Sure. And I don't want to get into how I would measure that. I mean, in fact, I try to, but it's quite difficult. But the real bet is, can this team with a great vision and a passion for what they're building achieve some semblance of impact that sounds like what they aim to back? If I were a government regulator and I wanted to set up a system to make sure that the dollars are going to a measurable, achievable impact at pre-seed, I'd probably quit my job. because if you understand that any clause you put on founders, any restriction you put on fund managers, any system that you try to standardize, be it B Corp or be it the United Nations Global Reporting Initiative, et cetera, can create massive inefficiencies with a company that has three months of runway.
Yeah, so the constraints essentially will end up killing the business rather than empowering the business to do what it needs to do.
Frankly, the only impact that I feel I could measure or manage is just, do I help create an environment where I help catalyze, basically? And the word catalyze is the word for it. So having said all of that, back to the idea of claims. So in the EU, there's this SFDR program. It's the Sustainable Finance Disclosure Requirements. I believe that's the term for it. And getting a call here, just a moment. They set up this program in EU that basically puts the onus of claims onto the fund manager.
Oh, wow.
And I think that is a mistake. And I think that in a place where you have massive subsidies for risk taking, i.e., backing fund managers through things like government subsidies or something like that, in that exaggerated world, that could make some sense. If, for example, the US government wanted to give me $100 million to catalyze my early stage fund, okay, I'll hire some people and I'll pay for each of my startups to go through training programs, and we can have a retreat camp, and we can all sit down and talk about impact, and we can, whatever it is, set it up, get it to go.
I mean, essentially, it's incentivizing the wrong behavior, right?
Well, I didn't say that, but I was being sarcastic to some degree. But just to put this exaggeration to a point.
Yeah.
in the world of high risk, when it's ultra speculative and there are 5 million directions the founders can go, I personally believe that as a fund manager, I would be wasting my founders' time to say, you need to be doing it this way, you need to report it this way. For the first year or two, they should be experimenting, in my opinion. That's my opinion. I think that the ability to experiment and grow and change and pivot is an exercise in trust that a lot of people are not comfortable with, because, again, we don't know how to measure trust. It is just a word. And that reconciliation of the personal aspect of impact and building trust with the founding teams, and literally just being here to support them and defend them, by the way, not making claims for them, but just defending their pursuits and experimentations and their ability to grow into something that can be a massive financial success. That's my only goal. And I tell my LPs this, and it gets me into trouble with some who think that I should be measuring and monitoring impact in a way that should be a standard or something. I simply don't care. My job is to back innovation.